What happens when the governments try to fix one problem but end up creating another? In India, a thoughtful move to ease the burden of gold imports has unexpectedly swelled into a 1.12 lakh crore puzzle by 2032. It's centered on gold, a symbol of joy in every household, where the sovereign gold bond scheme sought to shift habits with care. Aimed at stability, it met soaring prices instead. Let's uncover the story. Launched in November 2015 under the Modi government, the SGB scheme was a bold move to shift India's gold obsession from physical bars and coins to a paper-based alternative. The idea was simple yet ambitious: offer investors government-backed bonds tied to gold prices, paying a modest 2.5% annual interest rate with a redemption after 8 years or prematurely after 5, at the prevailing market rate. The goal was to reduce India's massive gold imports around 300 tons annually, which strained the current account deficit. By issuing these bonds, the Reserve Bank of India, on behalf of the government, essentially took a financial position. It would pay investors based on future gold prices. At the time, gold hovered around 26,000 per 10 grams, and policymakers likely assumed stability or modest growth, making the scheme a cheaper borrowing tool than traditional securities. Fast forward to the early 2020s and the plot thickened. Gold prices began climbing, fueled by global uncertainty, inflation fears, and central bank buying. By 2024, prices reached 84,900 rupees per grams domestically, a steep rise from the SGB's early days. This surge turned the government's bet sour. Each bond issued at lower historical prices now promised payouts far exceeding initial projections. For instance, the SGB 2016-17 Series 1, issued at Rs 3,119 per gram, could now redeem at over Rs 8,500 per gram in 2025, with 67 tranches raising 72,274 crores and liabilities ballooning to an estimate of Rs 1.12 lakh crore by 2032. The government faced a fiscal nightmare. Critics argue this was a naked shot on gold, unhedged, with limited upside but unlimited downside as prices soared. By February 2025, the government signaled retreat. Finance Minister Nirmala Sitharaman confirmed the scheme's discontinuation in the budget, citing unsustainable borrowing costs. No new tranches had been issued since Feb 2023, and premature redemptions were open for bonds from 2017 to 2020, with dates set through September 2025. Yet the damage was done. 132 tons of bonded gold remained outstanding. Some claim that the government might sell 20% of its 854.73 tons of gold reserves to meet these redemptions. That is a hefty slice of a national treasure, stirring unease among citizens who see gold as more than wealth. It is heritage. Such a move could steady the books, but at what cost to a gold-loving nation's pride? The SGB saga, once a beacon of innovation, now stands as a cautionary tale of betting against a metal that refuses to bow.